Welcome to Right on the Money, the weekly talk show with interviews you can use to help you maximize your money and optimize your financial future. Before moving forward with any of the ideas discussed on the show, always consult your financial advisor, insurance professional, or tax consultant. Looking for financial help or a second opinion? We can help you in your search. And now, your host of Right on the Money, syndicated financial columnist and money-colored commentator, Steve Savant.
In this segment, we're talking about annuity riders and what they can do for you with Liz Cornell, author, popular platform speaker, and certified annuity specialist. Hey, I have to ask you, just because my audience will, what is a certified annuity specialist?
That means that I know everything. I'm just kidding.
Wow.
That just means that my niche, my specialty is specifically within the annuity products themselves. So riders, which is what we're going to be talking about here shortly, the products themselves, the different types, where they make sense, where they don't make sense, and where to position them within somebody's retirement plan.
Now, a rider, if I understand this correctly, is kind of like an adjunct onto the contract. You know, you're going to add something onto it. Some of these riders there could be a cost behind it.
Yeah,
Some
absolutely.
of them are embedded in the contract. We're not really sure. It depends upon what we're talking about. Give me a rider that you say, Steve, when you're thinking about annuities, you should consider this rider.
Well, first and foremost, especially because they're popular with the geriatric community, you should be looking at products that have a long-term, I say long-term care rider, but something, unfortunately, as you get older, things come up medically that you just don't anticipate. That's just part of, I guess, aging. And
By the way, I just saw, and I don't mean to rebel this, but I just saw an article that said the average baby boomer will spend about $250,000 over their entire retirement based only on medical issues. So, wow. So I totally get that.
Oh, yeah, absolutely. And one of the biggest concerns with folks is if something comes up and I need access to that money, that I don't have it. And that's not true. I would say most products on the marketplace today have some provision, some rider that says if you can't perform 2 acts of daily living, if you get confined to a nursing home, if you need home health care, or you get are diagnosed terminally ill or critically ill, that they will give you access to more money than what the underlying contract may provide, and or pay you more depending on what it's attached to.
All right, so let's just think about this. Yes, I think that's a worthy rider to consider. If I'm thinking about this as a long-term care expenditure, they may be able to give me money. I don't have to worry about my annuitization. Maybe I can get out of it if I'm getting payments, because there's certain things that can trigger those riders to intervene and then supply us with this funding. Like, again, for your example, long-term care.
Oh, yeah, absolutely. And I will give the insurance companies a lot of credit for this, that they've come a long way, especially in the last probably 10 or 15 years. And they understand, they kind of get it now that, yes, things come up, things you don't foresee. And especially because these products are popular with the geriatric or retirement community, that they need to have those provisions in them. And so they get it. Most of the products now that are available have some sort of provision in them in one way or another that allows you access to more money in the event that comes up. And that's one of the biggest concerns.
Now, you mentioned, of course, we mentioned long-term care, but I think you mentioned even imminent death. If you knew you were going to die, did I hear you right on that? There's actually some provisions, or maybe a rider that could actually say, hey, I know you're not going to live for the rest of your life. We'll go ahead and then expedite whatever's left in your payment?
Oh, yeah, absolutely. You just have to tell me when you're going to die or get promoted.
Well, I don't know when that's going to happen. However, I have noticed that the new 2012 mortality tables for annuities just was released in 2016. And because we're living longer, I noticed that mortality credits, the secret sauce of annuities, so to speak, the alpha of annuities, has really going to be decreased. And so the payments are going to be a little bit because we're living longer.
Yeah, absolutely. So if you're considering or looking into annuity products, now is the time to do it. Yes, people are living longer. I think that's good news. The bad news, as far as what I specialize in, of course, yeah, it affects the amount of payment that it is that you're going to get and how they price things within the product.
When we're talking about other riders, here's one I think this is a huge one. Just this year, 2016, Social Security, we were notified of everybody, if you're receiving your Social Security, you are not getting a bump up for inflation this year. So I've noticed that we have some options in annuities to actually add on a rider, a cost of living adjustment rider that we can put on our annuities and actually guarantee an increase every year.
Oh, yeah, absolutely. And that's one of the biggest things, retirement planning, outside of annuities or not, that you should be planning for. One of the biggest benefits of the annuities is that it guarantees that will happen. So, yes.
So let's talk about why you think this is going to be a powerful tool for using a rider, especially a cost of living rider. I'm thinking I saw a couple of weeks ago, we were out there, I saw a couple of them that were actually paying, you could get as high as 5-6%.
Oh, yeah, absolutely. And that's one of the biggest things outside of annuities or not that people should be planning for. Again, it's having annuities as part of your overall plan, especially in retirement, because in retirement, having that income and being able to cover your monthly expenses, but also that you're keeping up with inflation, right? Milk may cost $1 more a few years from now. And though the CPI says we don't have any inflation, I mean, most of us could probably say that things cost more than
Well, I know they say that, but my gasoline bill, well, gas right now is pretty good right now. But I mean, we're tied to groceries, gasoline, utilities. Those things all cost money in retirement, and people are already they're figuring out what their lifestyle are going to be for this. Now I'm thinking about the annuity. I want to get back to the inflation. Okay, so let's say we buy an annuity, and we have the privilege of making an annuitization, or even buying it. I guess I've heard that you have not only you could annuitize it for your life, but you could buy it in 10-year certains, or 15-year certains, or 20-year certains.
Oh, yeah. And to articulate that a little bit further, with any annuity, you have basic ways for taking out your money. I mean, that's what the annuity contract is itself. It is a contract that tells you all of the ways that you can take money out of your annuity. A couple of options. One is being an annuitization, which I say it's kind of the oldest form of using an annuity. It's how it's been done for a really, really long time. But on the rider topic, there are these riders that have been introduced that you don't have to do an annuitization. An annuitization, in its simplest form, it is basically a irrevocable decision for taking income. That's not to say that nothing goes to your beneficiaries, depending on what option it is that you pick. It's not to say that it is a bad thing. And I like to make sure that this is clarified, that in annuitization, it is a right within a contract. It is not an obligation. It is something you never have to exercise if you don't want to.
Okay, well, what's the option if I don't want to, and I still want to be able to get some income?
Oh, yeah. Electing an income rider. And income riders are the same basic principle, but the consumer stays in control of their money. It's yours. It's not the insurance companies. And to me, capital long-term is your flexibility, right? Things come up, things change. It's great that you're getting this income from this account, but something unforeseen comes down the road. You need to be able to take that cash out. Again, for medical reasons, who knows? You need to move. Whatever the case may be, and having that capital there and having the income rider that can still guarantee that lifetime income. But if you change your mind, if something comes up along the way that you didn't prepare for, you do still have access to that money and you can pull it out if necessary.
Well, and one of the gripes about annuities is that they're not liquid, but I've heard you talk about, listen, there's 10% withdrawal. Talk about that.
Oh, yeah. I think the biggest oxymoron to me is that people with annuities, and I ask this at my workshop, the class that I do, and I say, why won't you buy an annuity? And the first person always says, well, because I can't get my money out. Now, the irony of that statement is an annuity is the only thing on the planet that is designed to give you your money. That entire contract is basically all of the ways that you can get your money. And in order for you to really leverage that, again, you have to be more deliberate with product that you pick and how you want to take those distributions, because they're all priced to do something a little bit more specifically. So a 10% free withdrawal. I would say 90% of all annuity contracts on the planet today will allow you to take at least 10% penalty-free every single year during a surrender schedule. You don't have to exercise it if you don't want to. It's not to say that it's the only way that you can take money out of your contract. But most annuities have provisions in them that give you your money. It's just a matter each year of determining which one you want to use.
Now, you just mentioned surrender schedule. Why don't you mention that before we go to the break?
Oh, yeah. Surrender schedule, and this is how I explain it, is that it's basically the commitment, how long we tell the insurance company we're going to keep our money with them, right? Because the insurance companies, they make money reinvesting your money, right? So they need to know how long are we going to have that money so that we can reinvest it and be profitable as a company, right? In order for them to do that, they need a commitment from the consumer, right? So a surrender schedule, and how I explain it, is just it is the basic amount of time that you tell the insurance company you'll keep the bulk of your account with them. It's not to say you don't have access to your money. It's not to say you cannot take money out sooner, but it's the length of time we tell the insurance company as a consumer we will keep our money with them. Now, if we choose to leave early, yes, there is a penalty.
Now, they can be stiff. I mean, right? I mean, it could be a nickel. It could be 7%. I mean, there's some big numbers out there.
Yeah, absolutely. I tell people this all the time. The longer the surrender schedule, the better the product probably is, okay? To me, it's just basic math. If an insurance company has a longer commitment from you, they're probably going to pay you better interest. They're probably going to have better income benefits. But again, it comes back to being more deliberate within your product picking. Every carrier, every product is priced for something. So you have to be more deliberate. Again, I keep using that word, in that I am picking this product to do this thing.
So it sounds like I can buy any kind of period.
Oh yeah, absolutely. You can get anything you want to in the open marketplace today.
Well, remember, if you're listening to our show on radio, iTunes, or a podcast, you can view the video version online at rightonthemoneyshow.com and request information from this segment. Well, that's our show for this week. I want to thank Liz Cornell for being my guest. But before I go, remember what the good Reverend John Wesley once said: make all you can, give all you can, save all you can. I'm Steve Savant. We'll see you next week right here on Right on the Money.
For more information on this week's money topics, just go to our website at www.rightonthemoneyshow.com and follow Steve's daily postings on Facebook, Twitter, and LinkedIn. When it comes to retirement, money management, small business, insurance coverage, college funding, or budgeting, we have the interviews you can use.